Very good afternoon to all the viewers who've joined this webinar. So today the topic will be markets, valuations, and more. And I have with me Chirag Setalvad, who is our head of equities. Chirag doesn't need introduction, and we'll discuss overall markets across the board, while also we'll try to include some strategy specific discussion on portfolio positioning, etc. So before I hand it over to Chirag, just wanted to set the tone a little bit. So markets have done really well in the recent past, thanks to the strong macro environment surrounding our economy. Today, India is among the fastest growing countries in the world. We have also had subdued levels of inflation, even during the times when we've seen wars in various places across the world, and inflation just shot up in US and other parts of the world, which truly makes India a kind of oasis in the global desert. So the flows from the domestic investors have also been strong. However, at this juncture, as we have seen the market levels go up, people have been asking the question in terms of whether to invest at this point in time. Can I start my SIP? Which sectors are good? The debate on large versus mid cap versus small cap. So many questions are there in investors' mind, and that's we'll try and address most of those questions in today's webinar. Before I hand it over to Chirag, just wanted to showcase some data points. Okay, thanks. So as we talk of a situation when the markets have gone to high levels, there were various instances in the past also where we have seen the markets having gone up and people starting to invest. So we've tried to do some analysis in terms of we've taken a couple of time periods, say 2008 when the markets were at its peak, and also the next slide will be showing a time in 2017-18 when the small cap, mid cap stocks had run up. So we've just tried to analyze in terms of if an investor has started in SIP during that time, what would have been the performance. I mean, even if our luck was so bad that we started at the peak of these market levels, how our SIP would have performed. So here's the data point. If you see, SIP started near GFC peak, GFC as in the global financial crisis in 2008. And the SIPs continued till now, and that would have generated a CAGR in our mid-cap fund of 21.82%. So this is a mid-cap fund SIP since that time. What about some investors who were extremely lucky starting the SIP at the bottom levels? The return would have been 22.23. That's the difference, 21.82 versus 22.23 in the same fund. While on one set of investors, the timing was extremely bad. For the other set of investors, the timing was extremely lucky. So that's the difference between the luckiest and the unluckiest of all. Minor differentiating. Only thing is that you've chosen a fund that has continued for a long period of time, and the waiting time is long. I mean, your investment horizon was long enough to see this. So that's the difference if you were lucky or unlucky. So another analysis on the small cap fund. This time we have taken a time period from 2018 till now. So investor A starts the SIP in small cap fund in Jan 18. That is the peak of that particular market time. So till today, till August, the CAGR would have been 28.5. Investor B started in Jan 2009. That is post correction. Somebody starting an SIP at that time. Here, the market value of investment is actually lower than the somebody who started at the peak. The CAGR is 32.8%. So while there is a small difference, 28.5 is not that bad. So that is the difference once you are willing to wait it out for a long period of time in equities. I mean, even if the timing was wrong, the return is not that much different. So I'm not saying that I'll leave it to Chirag to discuss the nature of the market right now. But even if you go horribly wrong in timing, when it comes to SIP, provided you wait it out for a long period of time. Things okay. That's it from my side. I'll end my slideshow. Chirag, so I'll leave the floor to you now.
Fantastic. Thank you, Ram, for the introduction, and thank you everybody for taking the time to attend this call. The intent of the call is to talk to you a little bit in terms of the economy and, of course, the equity market outlook, and we'll touch upon valuations, large cap, mid cap, small cap sectors, and so on. So let me start with the economy bit, and I won't touch upon every slide, so I will skip some of these. But let me first just run through the slides. On the economy, I think one thing which is very important, everybody talks about how India is doing particularly well at this juncture. But I think what is important to keep in mind that India has actually done well over an extended time frame, and that journey continues. Growth in India has been roughly 12-13% for the last 40 years. So what we've done here is we've shown you growth over the last 4 decades. We've broken up into decade buckets. And what you can see is despite all the challenges which have occurred, India has grown actually quite well on a consistent basis. And in fact, we are today in an environment where some of these challenges have receded. And in fact, there are a number of positives which are occurring in India. So there is no reason to believe that India's growth will not sustain, if not possibly go up from where we are today. And the Indian narrative is extremely strong. And these are some of the factors that we think are very positive, which are impacting the economy today. So I'll quickly go through some of them. Some of this you may be familiar with, but I think it is important because these are important trends. These are large trends, and these are trends that are likely to sustain for several years going forward. The first is we continue to see a significant shift of demand from unorganized companies to organized companies. And this is visible across a variety of sectors. The first impetus for this was really when we had demonetization. But subsequent to that, we've of course had the implementation of GST and then the advent of COVID and increasing urbanization and brand awareness. All of these things have pushed demand from the unorganized sector to the organized sector. And this is a trend that we are seeing across industries, whether it's in plastic processing, whether it's in pipes, whether it is in apparel, whether it's in retail, whether it is in automobiles. So this is a trend which we think will continue for some period of time. The second is the China plus one story, which is unfolding. For a long time, the China plus one story was just a story. It was a hope and expectation. This is now translating into reality. And again, there are several factors behind it. The first, of course, was that Chinese costs started to increase. And that is why a lot of manufacturing companies globally started to look for alternative sources of affordable manufacturing. On top of that, when you had the advent of COVID, then the realization that you need to diversify your supply chain became imperative. And hence, the move of China plus one gained further momentum. And the third, of course, is from a political standpoint, China has become a more difficult country to deal with, and that has given further impetus to the China plus one momentum. So that is a trend which we think will continue for an extended period of time. The third is banks today are in a very healthy situation. On one hand, capital adequacy is very high. On the other hand, NPAs are quite low. And banks literally provide the liquidity which pushes the growth and the economy forward. And hence, having a healthy banking system is extremely important. And considering the situation today, it's great to have a banking system which is in the pink of health. The fourth is that the housing sector is showing signs of improvement, and housing is a large, important sector which drives demand not only for when you buy a house, you drive demand for a lot of products which go into making a house. So that includes, of course, cement and steel, but also includes home improvement products and consumer durables and carpets and furniture and so on and so forth. So the fact that housing is doing well bodes well for a variety of sectors. And housing is doing well for a couple of reasons. One is affordability is fairly high. If you look at, for most people, salaries increase at 7 to 8% per annum, which means that in the last 10 years, salaries would have doubled. And in that same period of time, real estate prices would be up anywhere from 15, 20, 25, 30%. So that means that salaries have risen far quicker than underlying real estate prices, which means affordability is quite high. Of course, there is a wealth effect which is also taking place with stock market capitalization hitting $5 trillion. A lot of wealth has been created, and that is moving into another asset class, which is real estate. And thirdly, we are seeing the impact of RERA. It provides a much more healthy regulatory mechanism where uh, developers are held accountable for providing products in a timely manner, in a cost-effective manner. And I think that is an extremely important framework which is now in place. And hence, we think housing will be something which will continue for many years to come. The fifth, and a lot of attention and a lot of press has already come on this, is in terms of government spending on infrastructure. And this is a big positive, and we expect that this will continue. We've seen that in but in several budgets over the last few years, that the focus of the government continues to be on investments and on infrastructure creation. And this is a trend which is likely to continue going forward. The government used to spend 1.5% of GDP on infra. It now spends 3.5%. And almost 30 to 50% of incremental investments are now going into infra. And we think this is a trend which will continue for many years to come. And the last is we've seen in the last few years corporate deleveraging taking place. So companies' balance sheets are in a far healthier place than they have been in the past, and profitability is also at a multi-year high. And we think this is a ripe environment in which corporate capex can also improve. So these are some of the big positives. So let me just highlight what we have pointed out. That GDP growth for the last 40 years has been very strong. And considering the factors that we have pointed out, we see no reason that why GDP growth will not continue to be strong and in fact may even pick up. And importantly, this is in an environment where globally things are slowing down. Europe is growing at between 0 to 1%. America is growing right now at 2 to 3%, but likely to grow between 1.5 to 2.5%. So growth in the US is slowing down. Growth in Europe is challenging. Growth in China has certainly slowed down dramatically from what used to be 9-10% to 4-5-6%. So really, India in that sense stands out as a beacon of growth, and as Ram pointed out, a sort of oasis in a desert of absence of growth globally. And India is gaining a lot of attention as a result of this. There are, of course, concerns which will always be there in all market environments. But the global slowdown is, I think, one of the chief concerns that we have. I pointed out that the US will slow down. Now it's not clear whether it'll be a hard landing or a soft landing, and that debate is very active and switches from one to the other quite often. But the US, whether it's a hard landing or a soft landing, there will be a landing and therefore a slowdown. And Europe, again, it faces a number of structural issues from a cost standpoint, and there are a lot of challenges in that geography. China is also facing issues from a real estate standpoint. So as these economies slow down, there will be an impact on global demand, and that will also impact Indian companies to some extent. We have seen interest rates which have risen quite considerably in the last couple of years. And while interest rates may come off a little bit in the US going forward, we still do believe that inflation will remain elevated. And hence, interest rates will also remain somewhat elevated for an extended period of time. The other concern, of course, is geopolitical uncertainty. And we've seen a lot of this take place in the last year or so, but it has gone relatively ignored in the sense that markets have not reacted to it. We've seen issues in the Middle East, which are fairly serious. And despite that, oil prices have not corrected, have not gone up materially. Oil has not reacted, and risk premiums have not come off. So in that sense, that is a risk which is certainly out there. Of course, Russia and Ukraine is another large risk, and that issue has widened as Ukraine makes inroads into the mainland of Russia as well. And the last is, of course, that valuations themselves are a bit of a challenge. And we'll get into that in more detail, so I won't talk about it too much now. But the fact that valuations are above average is something that we need to certainly factor in when we think about returns from a medium-term standpoint. So this is some further elaboration on the points that we spoke about. I won't get into each slide into great detail, but let me just just give you some of the key highlights. What you can see in this slide, we spoke about the unorganized sector. And what you can see here is that the representation of the unorganized sector across industries, whether it's plywood or air coolers or paints or food and grocery and so on, is very high, and anywhere from 30% to 80%. And so when they lose share and the organized segment gains share, it's a significant tailwind from a growth and demand perspective. The China one plus one story, we again spoke about it, but it's important to keep in mind that it is not one factor which is driving China plus one. It is many. It is rising manufacturing costs, environmental compliance costs going up in China, political sensitivities becoming more and more from a China perspective, and of course, supply chain diversification, which everybody is aware of. India's competitiveness has also improved in this period of time with the advent of PLI schemes, the tax rate having come down very significantly, and a number of other government policies which are in place. Ease of doing business in India has certainly improved. So all of this positions India quite favorably. So while China plus one will benefit a number of economies, it will benefit Indonesia, it will benefit Vietnam and Philippines, but India will be a significant beneficiary because the Indian market itself is very large. So companies, when they think of India not only from a China plus one standpoint, but also that we can sell into India when we relocate into a large economy such as ours. The banking system, it's interesting to put the numbers in place. We spoke about a healthy banking system. NPAs are down from a peak in FY18 of 6% to less than 1% now. And in that same period of time, capital adequacy has improved very substantially and is at an all-time high. So banks are in a position to lend. Certainly deposits are a bit of a challenge, but from a balance sheet standpoint, banks are in a very healthy position. Some stress in particular areas like personal lending and microfinance may exist, but overall the banking system is on a very sound footing. Housing, we've seen some improvement because of affordability being reasonable, because of increase in wealth and RERA, which we spoke about. And what you can see is launches, the chart on the right-hand side, how launches and sales have started to tick up quite materially. This phenomenon right now is predominantly in the larger metros, but increasingly we expect that this trend will gain traction in tier 2 and tier 3 cities as well. The infrastructure focus, I think, is well known, but I think what we can also see on the right-hand side is how private sector capex is starting to improve as well after many years of being in the doldrums. And we think that this is a multi-year tailwind to demand. Global risks, this just puts some of the numbers in perspective, but we are certainly seeing a slowdown. It is partly because excess savings are coming down. These excess savings came around during the time of COVID and the impetus that governments provided. But we are now seeing the impact of excess savings coming off, the impact of higher interest rates, etc., impacting global demand. And we do think that we are now in an environment which is likely to see higher for long interest rates, which are likely to be higher for longer, even though they may come off from their peak. So that it's very snapshot on the economy. I would summarize the economy a bit by saying that India is certainly in a very strong footing. The Indian GDP growth and the overall Indian economy is doing extremely well, especially both on a relative basis, which means compared to others, but certainly on an absolute basis as well. And I actually think this growth, there is a potential for this growth to improve. And one of the reasons for this, which is not highlighted so far, is that we've seen the rural part of the economy having gone through a lot of stress because of excessive inflation. And now that inflation has come under much more control, we are seeing early signs of the rural economy improving. We see that in the commentary of FMCG companies. We see that in the commentary of two-wheeler companies. And if the rural part of the economy were to pick up with 60-65% of the population resident in the rural sector, then that can give a further impetus to the overall growth of the Indian economy. So I think the Indian story is extremely strong. It is going from strength to strength and is likely to continue. Some dark clouds will always be there on the horizon. And in this day and age, that is more linked to what is happening outside of India, whether it is global slowdown or higher for longer interest rates and geopolitical uncertainties. But these are external factors more than they are internal factors. which takes us to equity markets, which is where I suspect everybody is a little bit more interested to hear our perspective. So let me start with valuations as far as large caps go. In fact, large caps have been the laggards in this market, and the Nifty even today only trades at a 16% premium to its 10-year average, and that's not a very material number, considering that the Indian narrative is so strong, considering that India's relative growth, while we may continue to grow at 7% on a consistent basis, the rest of the world is not. So growth in that sense gets further highlighted. India's growth gets further highlighted in a vacuum of growth globally. India's political environment is also stable with the new government coming into place. And that is not the case globally, where we are seeing untested governments in the UK, a new government likely to come in, well, a new government, a new government or a new regime in the US as well, which will add to some uncertainty. India doesn't have that. There is continuity in policy. And that is certainly a big advantage as well. So one can argue that India deserves to trade at a premium compared to the last 10 years. India's story today is better than what it has been on a relative basis in the last 10 years. So some premium is justified. Now one can argue that premium should be 10% or 20% or 30%. But I think a 16% premium is not asking for much. So we continue to hold the belief that large cap valuations continue to be sensible. We can see that in financial services, we can see that in FMCG, and we can see that in certain other sectors as well. So we remain constructive on large caps. And the interesting part on the slide on the chart on the bottom right-hand corner is that large cap is almost 2/3 of the overall market cap. So right now, all the focus, all the conversation, all the attention is on mid and small. But in that, we are forgetting the larger part of the market, which is dominated by large caps, which is 65% of the market, and their valuations are sensible. And that gives us a little bit more comfort on the overall market valuations. The part where we are a little bit more nervous on is the mid-cap valuations. Mid-cap valuations are trading at a 50 to 60% premium to historical averages. Now, I think a few points to make out here. One is that some premium again is justified because we've seen, as you pointed out several times, that the Indian narrative is fairly strong. So some premium, whether it's for large or for mid or for small, I think across all segments is somewhat justified. I think that's the first part. The second is, I think in general, mid caps have seen a little bit more discovery in the last few years. Some of it is cyclical in the sense that it will come and it will go. But I think some of it is also structural. People realize that this is no longer an environment where mid caps are dangerous, poorly run companies. The definition of mid caps, as everybody probably knows, is companies from 101 to 250 in terms of market cap. That market cap range is roughly 30,000 to 100,000 crores. So the mid caps of today are not what it was in the past. These are no longer sort of tiny enterprises or mid-scale enterprises, which have corporate governance and disclosure issues and so on. So I think there is some merit on that front as well to give mid caps a little bit more of a premium. So I think partly because of India story, partly because I think mid caps, the discovery of mid caps and the understanding of mid caps has moved up a little bit. Some of it is, of course, froth, but some of it is also, I think, justified. So should we be a little nervous on mid-cap valuations? Yes, I think we should be a little bit nervous. Does that mean that we have to be incredibly nervous on mid-cap valuations? No, I don't think so. I think we have to have a balanced perspective. And what that means is that after several years of very high returns in mid-caps, we have to adjust to a near-term perspective of having more moderate returns. So we cannot obviously expect the market to give 25-30% returns every year. And with those kind of returns in the bag for the last couple of years, we should expect a more moderate return environment going forward. But that doesn't mean that one should not be in mid caps. I think one has to follow a more calibrated approach. So step one is to reduce expectations of returns to what is a more sensible level. The second is not approach mid caps as a lump sum format, but to look at it more as SIPs. And Ram has very succinctly pointed out how rewarding SIP investments can be, even if they're done at valuations which are excessive, so long as you hold for an extended period of time. So I think three things to point out for mid-cap investing. First, reduce expectations, realize there is some risk. Two, put that money in more through SIPs than through a lump sum format. And three, and most importantly, hold those investments for an extended period of time. And if you do those three, then I still think you will come out with an outcome which is sensible. It may not be as fantastic as the last couple of years, but it doesn't have to be disastrous. I think a similar um, conversation can be had for small caps as well. Interestingly, the small cap premium is a little bit less than the mid cap premium. So going back to the earlier slide, the mid cap premium is 60%. The small cap premium is closer to 50%. So I think that's point number one. The point number two is similar to mid caps, discovery has gone up. Part of it again is cyclical. Part of it is froth or cyclical. Part of it is more sustainable or structural, as people would call it. I think the quality of small caps has improved. You can see ROEs have changed quite a bit in the last 10 years from what used to be high single digits to low double digits. So there's been certainly an improvement in ROEs. At the same time, debt equity has come down. What used to be 1.5 odd times is now closer to 1 time. So leverage in the system has come down as far as small caps go. I think the level of disclosure has moved up very, very materially. There was a time when it was hard to access small cap companies. Now small cap companies are much more accessible. They disclose a lot more. And there are a wide variety of small caps to invest in, which I think is an important point, because while overall valuations may be expensive, we can still find pockets of sensible valuations. It is becoming harder and harder as the market goes up. But you don't have to buy, 50% premium means there are some things which are at 100% premium and some which are at a 20% premium, keeping quality the same. So I think it's important to rotate one's portfolio. So you have to sell some of the things which are no longer justifiable. But are we able to find things which are still somewhat sensible? Yes. It is becoming harder. The number of sell ideas are becoming are enlarging, and the number of buy ideas are shrinking, which is what you would expect as the market becomes more expensive. But it is not that we have no buy ideas and we only have sell ideas. So again, I would approach small caps in a similar way to mid caps that keep a very long-term perspective. I think that's important. Do an SIP format as opposed to lump sum. And I think some premium in this segment, again, is justifiable. I don't think 50% necessarily is justifiable, but 10, 20, 30% is something which is at least in the realm of sensible debate. Flows into this category have also tempered down, which is what we show on the table here. And I think that's healthy. Some of it, of course, is going directly into markets and not getting routed through institutions and mutual funds. But we are seeing some tempering. And I think the recognition that valuations are excessive is now commonplace. So what is possible is that we may see a little bit of a time correction, a little bit of a price correction. But for those who hang around, invest on a continuous basis and hold on for an extended period of time, I think can still have a sensible outcome. But once again, I think we need to temper our expectations of returns. I think those return expectations have moved up as the market has moved up, and we need to bring that down a little bit. I won't talk about earnings growth, but I think it's important to give a brief commentary on sectors. Valuations, as you can see out here, are challenging across most sectors. But I will point out a few segments which we think are relatively more interesting. I think financial services, I think the market is in a position where it will rotate. Market rotation is something which has happened for decades and decades and decades, and sometimes we forget about it. So before I get into sector commentary, let me explain what does rotation mean. Rotation means that a segment of the market becomes excessively valued, and then the market moves into a segment which is relatively more sensibly priced. And that doesn't only have to be from a sector standpoint. It can also be from a style standpoint. So there was a point of time when growth was excessively valued, and then the market rotated into value. There was a point, there've been several points of time when individual sectors have been very expensive, and then the market has rotated into sectors which are relatively less expensive. So you see sectoral rotation, you see market cap rotation. There are times when mid caps outperform, and there are times when large caps outperform. And I think that's important to keep in mind. So from a sector standpoint, let me highlight, let me start with valuations and then I'll touch upon some of the more fundamental factors driving sectors. From a valuation standpoint, I think the two segments which stand out to me are consumer staples and financial services, both of which, both in both cases, valuations are much more sensible compared to the past. In financial services, both absolute and relative valuations are in our favor. In consumer staples, maybe not from an absolute standpoint, which is not the P's themselves, but from a relative standpoint. What that means is consumer staple valuations compared to IT, compared to pharma, compared to other sectors is a lot more sensible today than it has been in the past. And if the rural recovery were to truly take hold, then consumer staples could potentially do quite well going forward. So these are two segments where we are finding more interesting ideas. Now, having said that, let me briefly touch upon sector dynamics. Auto, we are seeing some moderation in demand, and as most people may know, that the two-wheeler segment is doing particularly well, but we are seeing some slowdown on commercial vehicles and passenger vehicles. On financial services, I've highlighted several times that valuations are okay. Balance sheet strength is intact. Capital adequacy is strong. We are seeing some concerns on asset quality in sub-segments like MFI, but we don't think it's a widespread phenomenon in the sense that it is restricted to MFI, it is restricted to certain areas of personal finance, but it is not across the board, certainly not on the corporate side. Deposit growth is a challenge, and I think what will happen is banks will temper credit growth down a little bit to bring it in line more so with deposit growth. Capital goods continues to remain a sector which is doing extremely well. Government capex is strong and private capex is also improving, and hence order books of companies are very much full up. Margins are healthy. The problem is really from a valuation standpoint, and that is why we are concerned. Consumer staples are highlighted. I think the point that we've not raised, we've spoken about rural demand potentially picking up. We've spoken about we've not spoken about the rural terms of trade are starting to improve, which is when we say rural terms of trade, it refers to the difference between food and non-food inflation. So when food inflation is higher than non-food inflation, it benefits farmers, and we are seeing that trend taking place today. The inflation impact is also waning to some extent, and that is good for rural demand as well. We are also seeing the government is providing a lot more incentive. We saw that we've seen that less at a central level, but certainly at a state level, where incentives are being provided. We saw that in the Maharashtra announcements more recently, and that can give a further impetus to demand to rural consumption. IT is a bit of a mixed bag in the sense that we are seeing some discretionary spending which is under pressure, but non-discretionary traditional spending continues. So there is some good news and bad news there, but again, valuations are a little bit on the higher side there. Domestic pharma is doing well, and we continue to see the Indian pharma market growing at 8 to 10%. In addition to that, we are seeing the pricing environment. So a lot of companies, as you know, would sell into the generics market globally, especially into the US. And generic pricing in the US, which used to come down 8 to 10% per annum, that pace has waned a bit. And we are seeing environment of generic product pricing becoming a little bit more sensible. And that can provide an impetus as well. But once again, valuations are a little bit excessive. So that's worth keeping in mind. I'm not going to get into flows into great detail, but I will point out that we are seeing flows. You can see that in SIP numbers. And I think the interesting part is the following. Mutual fund ownership, which used to be 4% of the industry, is now 9% of the industry. So ownership has moved towards domestic institutions. I think domestic institutions are a much more secular story in the sense that savings still in equities is on the lower side. SIPs have grown tremendously. And I think that will provide some support, which will prevent the market from some kind of volatility. It's not that we will not have volatility, but we can potentially have a little bit less volatility than the past. What worries me is the incredible retail participation that we are seeing, the frothiness that is there in the SME market. So I think those are things which the regulator has also pointed out, and something that we are also quite nervous about. The IPO pipeline will also suck up some of this liquidity. We are now seeing larger IPOs coming in, things like, so that can take out some of the liquidity. But liquidity right now is very ample. But I don't think I think that's more of a risk. When liquidity is at a peak, then valuations tend to also get frothy, which is what we've seen right now. And so we have to be careful that this liquidity may come off, it may not collapse, but if it comes off, it can certainly have a negative implication on markets. This is a quick snapshot on global summary, because we often think of India as an isolated market. We think of, as Indians, we don't really know as much of what's happening outside. So it's important to keep in perspective how valuations are in the global context. So let me start with the US, where valuations are certainly expensive. But again, there is, and I say again, it's a little bit nuanced, because it is driven by a handful of stocks. So we all know the Magnificent Seven, they've been spoken about a lot. So if you strip off the Magnificent Seven, then this valuation premium will come down sharply. It will still be at a premium, but not as sharp as what it is when you see the Magnificent Seven getting included. So US market is expensive, but it is largely driven by technology. Just like in India, it is largely driven by mid-cap, small-cap. In fact, US mid-cap, small-caps have done very poorly. It has really been the mega caps which have done extremely well. So the US is expensive, but if you strip off the select number of companies, then not so bad. Still expensive, but not so bad. Europe is trading at valuations which are very close to long-term averages. So valuations per se are not of great concern. The Japanese market has done very well, so that's the other large market out there, and valuations there are certainly expensive. We have not included China here, but if we were to, then the Chinese market is another large market. If we include Hong Kong and China, then even larger, where valuations are attractive. So it's a bit of a mixed bag. US a little bit expensive, Europe fair, Japan expensive, China cheap, India expensive. So some stuff which is reasonable, some stuff which is expensive. But it's fair to say that most global markets are tilting towards higher valuations for sure. And that's because of global liquidity. It's because of the money which has come in during COVID and some of those factors. So let me summarize it. We've highlighted in green the positives and some of the concerns in negatives in red. India continues to do extremely well, and I think we should not lose sight of that. The continued thrust on infra is likely to sustain growth. Private capex may certainly rebound and is in fact rebounding. Rural recovery is still at an early stage. We have to monitor it, and it can be a big positive were that to happen. The negatives are that we've spoken about global inflation and geopolitics and so on, so I won't get into the global stuff. But as far as India is concerned, profitability is on a multi-year high. And if raw material prices were to move up, then that can certainly put earnings at risk. And I think that's something which has to be monitored and we need to be careful about. And lastly, we've spoken about valuations. I won't get into it and be repetitive. But it is fair to say that valuations are on the higher side. But I will spend just a last 1 minute on this before I go into the last slide. That again, it is a bit of a bipolar market in the sense that large caps, which is 65% of the market, is still sensibly priced. And while mid caps and small caps are expensive, I have pointed out there are some reasons for that, which includes India's overall growth story. It also includes the fact that these companies are disclosing more. It also includes the fact that these companies have better ROEs, lower leverage, and more disclosure than in the past. So some re-rating of these companies is warranted. But I would still say that that segment of the market, which is mid and small, should be approached with caution. You should certainly have a long-term perspective. You should ideally be investing through SIPs as opposed to lump sum, and look at market corrections for putting in more lump sum type of investments. So with that, I'll get to the last slide, which I think is incredibly important and where we typically find that people don't spend enough of time. We focus so much of our energies on choosing fund houses and funds, but I think very often we lose the fact, we lose sight of the trees when looking at the, we look at the, we don't look at the forest, we look at the trees. And what I mean by that is the bigger picture is important, which is that asset allocation that drives most of your return. And what does that mean? Equities will, over a longer period of time, certainly give you better returns than fixed income. And if you have a large portion of your portfolio in fixed income, you will, as a result, have lower returns. So getting the right mix of equities and fixed income is extremely important, as opposed to getting within equities the right mix of funds. So focus on asset allocation, how much is in equity and how much is in debt is very important. That will be determined by your age, that will be determined by your liquidity requirements, that will be determined by your risk profile. But do keep that in mind. I find very often investors will have 20% in equities and spend all their time choosing funds. But if you have 20% in equities, you are going to be weighed down by that lower allocation. And what is probably more appropriate is to have a higher allocation to equities and focus less time on individual fund selection. It is always important to be contrarian. When everything is doing well, we need to be cautious. When everything is doing badly, we need to be aggressive. This is something which is proved to be true over very, very long periods of time. Now, in good times, it is very difficult to see things worsening, and in bad times, it is very difficult to see things improving. But inevitably, both things will happen. Good times will temper, and bad times will also temper. So, being contrarian is extremely rewarding. Investing in the bottom of the financial crisis, investing at the bottom of COVID were fantastic times to invest, but difficult times to invest. At the same time, taking money off at the top in 2018 and possibly today is difficult to do, but it's probably sensible. So I do think some profit booking is merited. I don't think it should be large. I don't think it should be, it should move your portfolio dramatically, but taking 5-10% out and reinvesting that in a more gradual fashion, I think is a sensible approach. Investing for the long term, Ram has already pointed this out. I cannot overstate the importance of this. We still think of long term as 1 year and 3 years and 5 years. And in fact, most investor horizons are actually shortened, not lengthening. We should be thinking of investing for a minimum of 5 years, ideally for 10 years. And in a perfect world, we should be investing even for longer than that. Even if you invest at the worst of times, even if you sell at the worst of times. So whether you buy at the worst of times or if you sell at the worst of times, the strongest mitigant of having poor returns if you make those choices, those poor choices, is that you invest for a long period of time. So you invest at the worst of times, but you hold long enough and you will get redeemed, right? And vice versa. If you've sold at the worst time, but if you invested for long enough, again, once again, your returns will get redeemed. And I don't mean redeemed as in redemptions, but you will have a better return profile. The last is it's good to have a mix of SIPs and lump sums. There is a segment which has taken overly fascinated with SIPs. Those who only do lump sums. I think the truth is somewhere in the middle. You should do a combination of both. SIPs, as I see it, is your daily bread and butter. You should not get away from that. But lump sums is something which helps supplement that return profile. So do look at lump sums, but at the right time. I think this is currently a time much more suited for SIPs than lump sums, but there will come a point of time when lump sums will be a little bit more appropriate, and we will certainly call it out as and when we see that time. So let me just end with the last graph here on the bottom right-hand side. It shows you the Flexi Cap, one of our flagship scheme returns. Since its inception, the fund has given more than a sort of 20% return, or close to a 20% return. And the Indian investor is very suited, or I would not say suited, but very inclined to time the market, right? Get in at good times, get out at bad times, and so on. And that's, of course, investor perception, what is good and what is bad. But what we see is even it is not timing the market, but time in the market, which is important. Because if you miss the best 30 days, and we are talking about a fund which has been around since 1995, so for a period of 25 years plus, if you miss 30 days in a 25-year period, the best 30 days that is, your return profile would drop sharply from closer to 20% to closer to 12-13%. So timing the market is hard. It is hard for us. It is hard for you. And I would avoid that. I think instead we should focus on the fundamentals, which is asset allocation, be contrarian, invest for the long term, and use a mix of SIPs and occasional lump sums. I think that works very well.
Thanks, Chirag. Thanks, as usual. It's amazing having you on the call, and thanks to all our viewers. And you made all the points clear, and thanks again for that.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.